Welcome to Straight Talk on Retirement, your no-hype source for financial advice and making informed choices about your retirement planning. Get on the phone to talk today at 969-KTRS.
The opinions voiced in this show are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial advisor or tax advisor prior to investing. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Private Advisor Group, a registered investment advisor. Private Advisor Group and JBL Financial Services, Inc. are separate entities from LPL Financial.
Now, here are your retirement coaches, Jeff and Aaron Lapidus.
Well, hello, St. Louis, and welcome to Straight Talk on Retirement. You're live and local, St. Louis's favorite financial call-in show. I'm Jeff Lapidus, president of JBL Financial Services. Our offices are located temporarily in beautiful, sunny, yet incredibly cool, downtown Clayton, Missouri. I'm a 40-year veteran of the financial services area, a fee-based financial planner and wealth manager. And I'm joined this week and every single week by my very favorite oldest daughter and partner, Aaron Lapidus.
And we help our clients make smart choices about their money. The way we do that is by designing a game plan, a written step-by-step strategy, a real game plan that has several goals in mind.
First is to preserve, protect, and prudently grow the assets our clients have taken their entire lifetimes to accumulate. Second is to deliver a reliable stream of income, one that they can count on so they can do all the things they'd like to do during retirement.
And third is cost-effectively addressing their health care needs, like helping individuals enroll in Medicare and choosing the right plan to supplement their medical coverage.
And then when they're done enjoying their assets during their lifetime, we show them how to pass them on to the people they love, whether it's their spouses or children, grandchildren, churches, or charities, whoever it might be, with Uncle Sam or the tax courts taking a big bite out of their money. And as their wealth managers, Aaron and I watch their money every single day to make sure they're staying on track. And that's why they call us the retirement coaches. Babe, good morning.
Good morn.
I'll tell you what, it was fun to watch people's money last week.
Markets were doing excitement over a new administration.
Okay, that's one answer. I think it's really more because they're talking about doing another stimulus
Excitement
package.
over more cash.
More cash. More stimulus, right?
Well, that's part of the new administration.
Woohoo!
Janet Yellen said, pour it on.
Welcome, Mr. President.
That's right.
Get to work, baby. So it's fun. And again, good week last week in the markets. Hopefully you're invested, staying invested, being invested.
At your risk tolerance?
Exactly. And again, as a reminder, all of our clients are folks that are just like you. They're our listeners. They're those over the age of 55. They'd like to retire or they're already retired. And as Aaron mentioned, we do create a game plan for them with the goal of having a fun and financially secure retirement. Doesn't get any better than that.
Certainly not.
And before we start, I do want to thank all the folks that came and visited with us last week.
Yeah, it's nice.
The fear of COVID is starting to slowly go away.
Yes.
And we're seeing new folks by Zoom.
News folks by Zoom, by phone, but also in the office because
Yes.
through this entire crisis, we have maintained the appropriate protocols. So if you
Yes.
would like to come in and see us, we're only having one new visitor at a time.
Yes.
Got the masks, got the antibacterial.
Yeah, we've got a
hand
sign you can't
sanitizer,
line
all
up to
those
get
kind
into
of-
our offices. So it's
Correct.
okay.
So, and also we're trying to schedule to make sure that there aren't people passing in the night, if you will. So you'll be the only person in the office along with our staff. And
But
then,
it's great, and we're starting to see our
Yeah.
activity pick up again, which is really fun. And there's nothing better than helping folks
also, I think now there's a little
discovering
bit.
those rock stars, right?
Well, I think unfortunately January 1st happened and then COVID didn't magically disappear, which is what I think we were all
Yeah.
secretly, privately hoping was going to happen. And now people are really considering, do I want to keep working? Is this the environment that I want to continue in? And now we're seeing people making decisions that maybe now is the time to retire.
You know, it's interesting because the last couple of visits that we had with folks, what's fun is that we were able to uncover that they were rock stars. They had more capital and or cash flow than they needed to maintain their lifestyle in retirement, which is awesome. But it really came down to an emotional appeal. Were they actually emotionally ready?
Right. And in the past, we've seen people are not emotionally ready to retire because in a lot of cases, it's their social outlet. It's where they find a lot of their self-worth, and they draw a lot of meaning from that. But now we're finding that people are thinking maybe there should be meaning, self-worth, and enjoyment other places.
Yeah. I mean, other than the social side, the big issue for most people is, do I really want to walk away from the money?
Right.
That certainly became a more difficult situation if they weren't happy with their work environment, and they've been away.
It's easier to walk away from the money.
And that's really going to lead us into our first topic today, which is, do I have to wait till normal retirement age to retire? But before we get to that, we do want to remind folks that there's an easy way to stay in touch with Aaron and I during the week.
That's right. If you just log on to our website, jblfinancial.com, there are several ways to not only keep in contact with us, but get more information. The first is in the upper right-hand corner. You can click Contact Us, send us a question, request a coaching session, have a comment. Those go directly to our email, so we happily respond to those.
Which Aaron has stolen.
I have, in fact, so you get a response. In the lower left-hand corner of the screen, you can click Sign Up for our monthly newsletter. I really should have let that one hang a little bit longer. It would have been funnier. It would have been funnier.
I used to get all of them, and now I'm out of the loop.
Well, see, doesn't that just make it exciting when you walk in every day and see a new first appointment on the schedule, or someone has a fun, interesting question we need an answer to? It's like a grab bag every morning.
Yeah, it's not like when your mom's driving, I have to close my eyes. That's cool.
Well, certainly hope not.
Okay.
Or you're welcome to, like we mentioned, subscribe to our monthly newsletter. We call it the Coach's Corner. The pop-up box is located in the bottom left-hand side of the screen, or you can scroll to the middle of the page and click Sign Up. I can't believe we're already in, what is it? We're working on the last week of January?
Exactly.
Feels like just began.
But it's not too late. Erin and her staff do keep the last 6 to 8 months of those archived for reviewing, printing, or downloading convenience.
That's right. And if your computer is having trouble or you'd like to receive it by paper mail, we will be happy to send it out to you. You just have to give us a call. Give us that information, too.
314-863-0008. Again, 314-863-0008. Babe, you want to just give us a quick, if you can?
Well, yes, I can quickly do that as I fill the time opening.
Yes, each one of our newsletters does have 4 topics.
Yes, and we like to say that they are good for multi-generational families because it doesn't just address retirement. It really addresses financial security and different ways to increase that for yourself.
Yes.
First is also it's informational. So, for example, the first is an infographic, different inflation measures, different purposes. So this is a graphic depiction of the different ways that the feds use to target their inflation, the Fed target inflation rate. So you get to see like the cost of living index or the core price of cost of living index graphed out, and that's how they determine where they'd like the economy to hit in terms of inflation. The second article is Sequence Risk, Preparing to Retire in a Down Market. So this kind of discusses, as you're pulling money, what happens if you happen to be pulling money into a negative market. We know that's double negative.
Yeah, it's double negative, exactly.
Oh.
Many folks talk about sequence risk.
Yes.
It's important to keep in mind, but we don't really take it into account as a planning paradigm.
That's right.
We think that what happens is asset allocation over a long period of time will deal with that issue.
Help smooth your returns.
And also, at the same time, being very reasonable, and I guess I would say realistic is the best way to put it, in regard to planning for your outflows is what's important here. And we found that over long periods of time, 15, 20-year periods that we've been doing this for other folks, helping our clients with their retirement income, is that those amounts really have been stable, not really inflation adjusted. And at the same time, if we've been able to maintain those levels over long periods of time without having to adjust them because of up or down markets. So asset allocation is extremely important in this.
Watch out for these financial pitfalls in the new year. And so this is a nice article from multi-generations, like we just talked about. watching out for things in your 20s and 30s, so that could be for your children or grandchildren, in your 40s, maybe for your children or for yourself, and then also in your 50s and 60s.
It's great, and what we love to do, and we certainly encourage our clients to do, is to pass on the email addresses of their children.
Yeah.
So that what we can do is send that to them, and you can see some nice pictures of us. They'll know where we're located, what the show is.
Right, and the nice thing is the articles are very short. They're each maybe a page or a half a page long. So I think they provide a lot of nice information without an extensive amount of jargon.
You don't need a finance degree to read them.
Certainly not. We've written them, so they are concepts that we think are important, and we want you to be able to understand them. So we have not written them in
it's like the show.
Financial jargon.
It's like the show. So bring complex subjects down to a reasonable level.
And the final is income investors may find closed-end funds on sale. So this is just a different investment vehicle similar to a mutual fund that you might want to take a look into if you don't have it as part of your portfolio.
Or ask your advisor about, right?
Exactly. And you know what's great? We have our very first text question of the day.
Woohoo!
If I could pull it up. Good morning.
Good
morning.
Good morning.
Can you talk a little bit about what type of accounts your clients should keep their vault assets in? Hold on, I'm sorry. Technical errors. Don't get this too dramatic of a question. Can you talk a little bit about what type of accounts your client should keep their vault assets in before and after retirement? And if you have time, can you touch on TODs and PODs and if you can use those with real estate?
Great.
Thanks for the opportunity to ask questions. You are very welcome. You can ask as many as you like.
You know what I like is the fact that our texter has adopted our jargon. We call the vault, which is your emergency fund.
That's right. So what type of account would you keep this in? Now, should there be a difference before and after retirement? I would say no.
I would agree with you, honey.
Really, because vault assets, and we talked about this last week on the show, although painful, we think that you should be keeping your true vault assets, meaning the emergency fund that you would like to have on hand. If that's 6 to 12 months worth of cash, or that's a chunk of money that you feel comfortable for the next 6 to 12 months to have easy access to, you want to keep that at a commercial bank or your credit union. You want liquid, easy access, no penalties, fees, or obstructions in you getting at it, because the idea is if there's an emergency, water heater breaks, you unfortunately lose your job, you've got easy access to cash without having to pay for it, meaning putting it on credit. So that probably wouldn't change it pre or post-retirement, because the concept is the same. And that's also the same with investing, meaning we want you to have that emergency fund full before you start investing. So everyone should have that well before they get into retirement.
Very nice answer. And I think also coordinating with that, I know that in our family, and I would assume this is on purpose because your mom was probably directed this, and you know she is a smart one.
Mm-hmm.
We all bank at the same bank.
Yes.
We happen to all be with the largest bank in the country. And so it's easy for the bank of mom to be able to transfer assets to...
Allocate.
Yes.
Allocate.
Either temporary or on a permanent basis.
Permanently.
The mama bear to her cubs.
Right.
As it would be.
Well, and the original reason for all of that...
still called cubs. Yeah, they're not cublets or something, but yeah.
The original reason for that was not nearly as benevolent as Dad made it sound. It was more like so she could watch what we were spending our money on.
Yeah.
She liked to do that.
Yes.
Okay. Then the next
custody.
It was like a halfway. It was more like a halfway house because you had some freedom but not a lot.
Yes. Again, we called her Gestapo Gertie for a reason. So
that's appropriate.
So, again here, maybe that is a tip. It certainly makes it easy also, not only if your money's a commercial bank, but if your family members also are using the same banking institution.
And you'd like to monitor them. Okay, can you touch on TODs and PODs? So a TOD stands for transfer on death. This is for accounts that are after tax. They're not your retirement plan, so they're not IRAs or Roth IRAs. And POD stands for payable on death, which is essentially the same. Different banks just have use different acronyms, but the idea is that as opposed to having a beneficiary like you have in an IRA or a Roth account or your 401k or life insurance or an annuity, these are payable on death to your heirs or whomever you list as the individuals who you would like to transfer the assets to upon your death. You could have a joint TOD, which means that if your husband and wife, you have after-tax money, both of your names, you own the account equally, one of you passes away, it automatically, the banking institution will create an individual account, and then you'll change your transfers to those contingents to pass the money on to the next generation, or if you're donating it to charity, things like that.
Exactly. And again, the reason that we use this type of titling for non-IRA assets is so that we can bypass the probate process. Now,
can you put a real estate inside of a TOD?
The answer is...
some banks will let you?
I don't think so. I think what we're talking about here is the titling of the assets. There is a thing called a beneficiary deed.
Oh, for your house, yes.
And you can use that, I assume, for other property. And again, what that does is it works the same way as a TOD account. So you don't actually put the asset into a TOD, but you can use a beneficiary deed.
Okay, I guess I was a little confused because some banks do allow you to hold homes or real estate inside of IRAs. But I guess that would be for another purpose.
It wouldn't be residential. It would be
commercial or
So
sort.
Again, I would think that a beneficiary deed will basically do the same.
Right, it'll keep your home out of probate, meaning that if both you and your spouse, or if you're the sole owner of your home, pass away, then the house will automatically, the beneficiary deed will determine whom the home goes to.
Bypassing the probate process.
Exactly.
If you have a trust, usually you'll have what's called a residential trust or residence trust that's inside your trust account, that's being named by your trust, which is cool. Thank you again. Our phone lines are open. So is the text line, 931-5877, star 5877 for your cell phones, or 84126 from the popular KTRS text line.
Very popular.
We would love to hear from you. And again, as a reminder, if you'd like to subscribe to our monthly newsletter, easy to do. Just go to our website, jblfinancial.com, click on the lower left-hand corner. Sign up. We're happy to send it to you every single month by email if we can. And at the same time, if you'd like to ask us a question, or in many cases,
arrange for a coaching session,
just go to the contact us section. You could write us as long as a question as you want.
That's right.
We'd love to hear from you again, which is great.
Or for the first time.
Yes, that's true. Babe, I was going to say, let's get into our first topic while we're waiting for our callers today. And which is, do I have to wait until normal retirement age 66 in this particular case? 66, whatever, a few months to retire.
Oh, this is just such a you answer. Yes. No. Maybe.
It depends.
Good thing we got to the bottom of that.
Well, it depends on your game plan. And we have found that most of our clients, new clients, are visiting with us usually around the age of 62, 63. And many of them would like to get away right away.
Which means that they're 2 to 3, potentially 4 years off from their normal retirement age.
Yeah, and certainly in many cases where we see companies that go through purchases, layoffs, buyout offers, which we've seen lots of those. We've seen those with major airplane manufacturers. Obviously, 6-7 years ago, we saw that with a major brewery that was...
Seen them with some hospital systems.
Etc. So what it comes down to is, we think, is about faucet management, right?
That's right. So if we take a look at a very nice couple that we recently saw, Joe and Sally.
Number 64, right?
Both happen to be about 63 years, or Joe happens to be 63 years old, and Sally's only 61.
Yeah, Joe's been a carpenter his whole life.
Wow. So they currently have about $1.2 million in IRA assets and an additional $300,000 in non-retirement assets. That's probably because Joe could do all the work on the house, didn't have to pay anyone.
Well, and we have
found... And they're excellent savers.
Yes, we have found, I've found, especially as folks that are in the trades, they're just good savers.
Right. I definitely agree with that. And also, Sally is an administrative assistant at a physician's practice. So we've also found that the ladies are good savers.
Joe would like to retire today, if he can.
But Sally's really still enjoying her job, which is good.
But she wants Joe to stop. And really, this is because, in particular Joe's case, he's had some physical issues that have occurred over the years, and that's not unusual.
Sure, when you're in the trades, unfortunately, a lot of times your body gives out before your mind does, meaning it's time to retire before you necessarily want to.
So, of course, Sally loves her husband, and she just says, hey, if we can get him out of here, that would be great, and I'm happy to continue to work because I really like to do that, and that's not unusual.
Right, so then what we had to determine was, if Joe retires today, what does that do to their income flow? And then what will that do over the course of time when we get to the point where both Joe and Sally can take their Social Security?
And the nice thing for Joe and Sally is that we did this on our electronic whiteboard.
Using their information, so it's true to them.
Right in front of them, which is really great. And I think that, as I like to say, within 15 minutes, we were able to give them a pretty good answer.
So I know, Dad, that you usually like to start at the end, meaning when all the faucets are on.
Right. They're getting their Social Security, if they have pensions, etc.
So, right. So if we fast forward to essentially 5 years from now, because that's when Sally will be eligible for her Social Security. Joe will have already been taking it, but as we chatted with them, we found out that they're spending about $5,000 a month.
After taxes.
After taxes. So we gross that up by 20%, and we see that they need $6,000 a month to make their life work.
There you go. That's our magic number.
Correct. But we also have to add to that magic number because when we sat down with them and determined what their best health insurance options were going to be, we estimated that they would need about an extra $400 a month in order to cover that. And
that's because neither of them were able to participate, I think, in Medicare Advantage plans, right?
Correct. And also, we have added the full price of this back in because as a carpenter, Joe was particularly lucky in that he wasn't paying anything for Joe or Sally's health insurance, so they had nothing in their cash flow budget to account for premium expense. So we said, let's add that premium in to your expenses every month. It could become a buffer, or it's just nice to know that we can quantify what your expenses are going to be. So that means they really need about $6,400 a month. Social Security between both Joe and Sally will run $4,000 a month when they both get there.
Cool.
So when we subtract $4,000 from the $6,400 that they need, we see that they'll only need $2,400 a month, which is $28,800 a year when we fast forward 5 years from now, so 2025.
So at that point, their question was, do we have enough assets? And we like to call that, do we have enough assets to generate the milk money? And
so we say if we use a prudent rate of withdrawal of 4%, that means that Joe and Sally, over the course of their lives, will need $720,000 in order for us to generate $28,800 per year for them.
Right. So that really, at the end of the day, when they're both at normal retirement age,
right,
they're both receiving their Social Security benefits, we're assuming no pensions.
Right.
If they have $720,000 of assets available for income purposes,
right,
we should be in a good place. But we know to begin with,
we know that we're going to lose all of Joe's income and not replace it with anything yet.
Yes.
So if we let's rewind to see if Joe can retire today.
Right.
So today he still needs $5,000 a month. We still have to gross it up by 20% for taxes, which is $6,000. But because Joe's retiring, his health insurance is going to be significantly more expensive. Unfortunately, Sally doesn't have access to health insurance at the physician's practice. They don't offer it. So Joe's
had to add some dough in there, right?
Right. We had to add $1,400 a month because Joe was able to say, hey, it's going to be $1,400 a month for us to stay on the carpenter's plan if I'm retired.
So the question wasn't whether we had to add it in. The question is, does that make this undoable, right?
Right. So we added it in, and that means they really need $7,400 a month, not $6,000, which annually is $88,800.
Right. And we knew they were going to have to do that for 3 years until Joe reached his normal retirement age.
which means that they would need a total of $266,000 and $600 in order to...
During that time period.
Right, and that's assuming absolutely no growth on the assets. That's literally the amount of capital that they would need. Interestingly enough, I guess we decided not to factor in Sally's income into this.
No, we didn't in this particular analysis. We didn't. To show them, we will call it, let's call it the worst case, or as I like to think about it, as Sally is watching Joe snore in bed.
Well, she's not watching because she's got to get up and go to work.
Well, she's getting ready to go to work. We don't know how long that lasts.
So she should get to keep her money, is what you're saying.
Well, she might decide she wants to work. Doesn't want to work anymore.
Okay. So we're saying this is an unstable number.
That may hasten the time of her retirement.
Gotcha.
And that is unusual, by the way. But in this case, we said, let's look at the worst case scenario, which I think made some sense for them.
Okay, so that means from today till 3 years from now, when Joe reaches normal retirement age, they're going to need $266,000 in order to maintain the lifestyle that they currently have.
Right.
Now, when Joe gets to normal retirement age, he'll also be eligible for Medicare.
And Social Security.
We still know he needs $5,000 a month. We know that's really $6,000 if we gross it up for taxes. But now we only need $6,700 a month because we're only paying for Sally's health insurance at the escalated rate. We were able to drop down Joe's portion pretty significantly.
Cool.
So, and also we were able to add some income into the equation. Joe's Social Security is going to be $2,400 a month, so we can subtract that from the $6,700, meaning that now when Joe's Social Security is coming in, they only need $4,300 a month, which is $51,000 a year.
And that's a big drop.
Right, and they're going to need that for 2 years because we're still waiting for Sally's Social Security.
Yeah. Well, that's what you get when you rob the cradle.
So now that means that they are up to $369,000 of assets necessary pre-Sally's Social Security benefit.
Right. And if you add that to the milk money, which was $720,
they only need $1.1 million in order to make this scenario worst case work.
Right. And when we started in our conversation, we mentioned they had 1.2. So they're rock stars. Again,
we mentioned they had 1.5 because they have $300,000 in after-tax assets.
Sorry, babe, you're right, 1.5. So they're getting deeper into Rockstarville.
And also, just like you talked about, Dad, this is worst case scenario because they truly won't need us to provide them the full $6,000 a month as of today unless Joe decides to retire and then Sally is vindictive enough to say, I too am retiring now, this moment.
And also, we didn't make any assumption about the return or interest that could be earned on those assets whatsoever. We just said zero. So that's really super duper conservative, right?
Right.
The nice part is that we, in our opinion, they're rock stars.
So that means if you can be a rock star in the worst case scenario, just imagine what you could be in any derivative above that.
Any normal scenario, right?
Right. Any other scenario.
And I think at the end of the day, as they have found out, which most folks, I believe, do, when they come to that realization, they're able to see it on the board. We did the numbers right in front of them, just exactly the way we laid them out for you. They're obviously pleased. I mean, they're overwhelmed. But the truth is, what happened was they had choices. They realized they now had choices. We didn't talk about the whole concept of Social Security strategies, which when do we take, really wasn't as important. It also, whether Sally continued to work and how long she wanted to work, really changed her perspective a little bit. Yes. And it put her in a position where, obviously, if she did continue to work after Joe retired, what would then happen is that, or let's just say she decided, hey, babe, I'm going to go to full-time status instead of part-time, pick up the health care.
That would create some savings.
That would be very significant.
Okay, so let me get this straight. Joe and Sally are going to be sitting in the office, and Joe's just beaming because he gets to retire. And then Sally says to herself, babe, since you are going to be home all day, just enjoying your new life.
Missing me.
I am going to let the heart grow fonder, and instead of coming home, only working at 3 days a week, I am going to work 5 days a week.
Right.
only a man could come up with this scenario. Like, why would that happen?
It sounded good, honey.
Yeah, it really did.
You,
it really did. I'm just saying, let's be realistic.
I think you're being more realistic than I am, so I would agree. I would really agree with you. But
right.
Again, I think the moral of the story here is that
it's going to be a long honey-do list for Joe.
But what's neat is they had choices. And the fun part is having those choices not only empowers you, but I think it also helps you be a better investor. And it also helps you make some really good decisions. And in their case, we sent them home saying, let's think about things, see where we're at, and let's begin to lay in, I like to call it the yellow brick road. Okay, start laying in the foundation for when you decide you're going to retire. And, call us back we'll call you in about 10 days, see what you're thinking.
And also
and go from there.
There's multiple, like you were mentioning, Dad. This is I wouldn't say worst case scenario, but it's the most extreme case scenario because Joe's not taking till his normal retirement age. Sally's not taking till her normal retirement age. But when we drill down the numbers a little bit, we know that Joe's Social Security is $2,400 a month. Sally's is only going to be $1,600 a month.
Right.
Sally may decide if she retires early that she might take her Social Security benefit a little bit earlier. There would be a reduction in the benefit, so that would change the numbers a little bit. But we've seen over time, in a lot of cases, it makes sense for the lower income earner or the individual who has the lower Social Security benefit, which usually reflected that they were either a lower income earner or just worked for a shorter amount of time, to take the benefit, because in the event that either Joe or Sally passes away, the individual who remains gets to keep the larger benefit. So if Joe passes away first, Sally would get to take the $2,400 and drop the $1,600. If Sally happened to predecease Joe for whatever reason, Joe still gets to keep his $2,400. So some people decide they want to use the government's money earlier, meaning getting your own Social Security back, pulling less from your retirement accounts. And some people say, hey, I'd like to see that 8% increase. The nice thing here is we did it in the most extreme example, so anything in between there is just going to make the numbers a little bit better at the end.
Yes, and I had visited with some folks yesterday late in the afternoon that were in a very similar planning scenario. And what was interesting was that, just to kind of follow this a little bit further, the point you were making here, honey, is that their Social Security benefits were a significant contribution to their retirement income, but it wasn't the majority.
Right.
And therefore, putting off until normal retirement age, putting it off even past that till 70, to increase the income stream that was coming from Social Security wasn't a significant event because of the amount of assets that they already had outside of their retirement accounts.
Right.
So, reasonably, we know that the break-even is anywhere from 11 to 14 years if you're putting off Social Security over a period of time because you know the money that you're taking up front.
The money you're foregoing.
Yes, you're foregoing by, et cetera, versus in waiting. There's no wrong decisions here.
No.
And in their particular case, and it could be the same thing with Joe and Sally, is that, and I think you're making the point, is having that income stream and reducing the amount that we're pulling out of the spigot
from your retirement plan,
may make you feel more comfortable. It might make more sense.
Right.
There's no wrong decisions here.
Sure.
It's really just a matter of feelings. And frankly, this, as I've always said, and I didn't make this up, but it really, we find that it's true, is that we're trying to make the best decisions we can in the moment.
Right. Hindsight's always 20/20, but
it certainly is. And we don't know what's going to happen for people's future. We don't know what's going to happen with their health. We don't know what's going to happen with, frankly, the markets, with their wealth. We don't know what's going to happen with family members. And so making the best decisions you can in the moment
usually set you up to be able to reposition yourself if necessary. It's very difficult. I have found that over the 20-plus years that we've been working with folks and doing this, that hindsight may be 20/20, but the benefit of hindsight
really wasn't a great benefit for us in terms of some of the base decisions we made, because it was really just
Wouldn't have changed it.
It was a matter of faucet management.
Sure.
More cash flow now, less cash flow later.
Right.
So I think it was fun, and what's cool for them is that when they were leaving, they basically said, now we have more clarity.
Mm-hmm.
Now we have more to think about.
Right.
Because we have more options. And people make good choices when they have more information. And that's really what the fun of the coaching session was. And we hope that we'll be seeing them real soon.
Yeah.
Right?
See what they decide.
So that's kind of a fun thing. Again, our phone lines are open. We'd love to hear from you. 931-5877, star 5877 for your cell phones, or 84126 from the text line. I don't know. You want to take a break? We haven't done that in a long time.
In 40 minutes.
Exactly. So do us a favor. Don't touch that dial. Aaron and I will be right back after these messages. Now is when a small change can make a big difference. If you're not happy with your current Medicare coverage, take a look at Coventry Healthcare. They have a wide range of plans with great service and clear costs, including medical and drug coverage in one simple plan. Just call 1-855-338-9551, 8 a.m. to 8 p.m. 7 days a week. That's 1-855-338-9551. Now's the time to call Coventry Healthcare.
If you're turning 65 this year, you face one of the most critical choices for your retirement game plan: enrolling in Medicare Part B and choosing your Medicare supplement. I will help you safely navigate this process and find the health insurance plan that best works with your new Medicare coverage. Getting started is easy. Call me at 314-863-0008, 314-863-0008 to arrange for a free health insurance coaching session, or email me at aaron@jblfinancial.com.
Now, back to Straight Talk and Retirement on the Big 550 KTRS. Here's Jeff and Aaron Lapidus.
That's right. We're here back on the Big 550 KTRS Talk Radio St. Louis. Did you know that's what it meant? The letters?
Talk
TRS?
Radio.
Right. TRS, Talk Radio St. Louis. Very cool. Our phone lines are open. We'd love to hear from you. 931-5877, star 5877 from your cell phones, or 84126 from the increasingly popular text line.
What's the K for then?
Well, K is a letter that they assign for AM stations.
Oh.
Which is kind of cool. That's what I do believe. But I know that the TRS part is because I looked it up on Wikipedia. Just so you know.
Well, then.
As it would be. Well, good. So it's
verified information,
etc. So I guess what we should do is one of our very favorite segments, Smart Choices About Your Healthcare.
Sponsored this week and every single week by our very good friends at Aetna and Anthem.
Aetna, we're glad we met you, and thank you to the folks from Anthem.
Right. So this was addressed to me since it's a healthcare question.
Naturally.
First, I want to thank you for all the help you have given my husband in terminating his health care coverage when he retired. It's what we do. Very welcome. Happy to do that. Second, I have a health care coverage question for a coworker.
We love when they ask those, right?
Yes. He has recently been exposed to someone with COVID, but did not get it himself. That's very good to hear.
Mm-hmm.
But in the aftermath of all you have to go through when that happens, ended up with shingles. Well, that's unfortunate.
Oh, man.
He is contemplating going from full-time to part-time, which means he's losing company health coverage on that day. He turned 65 in September last year, so he could have applied for Medicare, but I don't know if that happened, if that had to happen by the end of 2020. I'm thinking that this would be considered a special enrollment period, but wanted to get your answer to that question. Please advise.
She's been listening to you, babe.
Well, I was going to say, I know that this very nice lady happens to be working, but if she were looking for employment, she's right. She already knows the answers. So, yes, the great news is that Sally's friend, we'll call her Sally, will have what's called a special election into Medicare. So Medicare offers several election periods. Your first is called the initial election period. That's when you are turning 65. It's what everyone knows about, that 7 months surrounding the month of your birth. Everyone's entitled to that unless you don't want it. you're entitled to have it, but you don't have to take it. The people that don't have to take it are those that are still working and have health insurance through an employer, or their spouse has health insurance through an employer. They have access to it. Sally's friend obviously was working when he turned 65, so he didn't take his Medicare benefits. Perfectly fine. Now we're outside of his initial election period because October, November, December is his last month of initial election. He now only has access to what's called a special election period in order to make his coverage line up. So what would happen there is first thing he would want to do is determine when he is going to cut back. I would suggest if his benefits are going to cut back the day he cuts back, he'll want to do it on the last day of a month because Medicare can only begin on the first day of a month. So you'd want to make sure, for example, if you decide that you're going to go part-time, you would want to make it January 31st in this particular case so we can make Medicare start February 1st.
Sounds smart.
First, you go online and apply for your Medicare Part A benefit. That comes directly from the government. It doesn't cost you anything. Then you fill out some paperwork because you need a special election. So first is your application to Medicare Part B. The second is called the Employment Information Request, which just says that Sally's friend has been on the coverage from September when he turned 65 until January 31st when he lost his access to coverage. So that will give him both his A and B benefits. They'll start on February 1st, which is great. So there'll be continuous coverage for him. And then he'll want to work with someone like myself or another broker that can help him choose the right supplement or Medicare Advantage plan to supplement his Medicare benefits.
Cool. And so what happens is to make sure that he doesn't have a gap. Because from what I understand, A and B have to be in place first.
They have to be at least in process. So, like, for example, this would be a very short turnaround time for this individual. But if he really wanted the February 1st effective date, we'd get all of the information submitted in January. Most likely, Social Security is not going to be able to process within a couple of days. So what the insurance companies allow for is as soon as you get the number, you can submit your application to whatever supplement or Medicare Advantage plan you'd like. They're going to hold it, and then as soon as you get your Medicare ID number, we can supply that to them, and then they will finish processing your application backdated to February 1st in this particular instance. You just have to have the information submitted before you want your effective date, so it could still be in process. But you do need A and B before you can do anything else.
It's good to know the rules.
Exactly.
Right?
It's important.
And we do want to thank Sally so much for listening to the show. Obviously, happy to help her husband, but
great to help a friend, too, yes.
Exactly. And I know that we do have Judy that's holding on line one, and she, of course, has a Medicare question. Judy, good morning. Welcome to the show.
Good morning.
Nice to hear from you.
Well, it's nice to talk to you. I'm actually calling you from Bok Tower Gardens in Lake Wales, Florida.
Wow.
My goodness, quite a distance.
Yeah. Jealous already.
Are you warm?
I got my first COVID test. I am now. The first week we were down here was awful, but I'm warm now.
Oh, you got your first COVID test.
Or COVID vaccine, not test.
Oh, okay.
Wonderful.
Well, congratulations.
Woohoo. Oh, so you're one of those people we heard about, which were the vacationer people that...
No. Excuse me, Judy is a healthcare worker.
Yeah? I thought you retired.
Yes, sir.
I thought you retired.
Do not forget.
Health?
Yeah, the Joe you were talking about, I think, is my husband, because he's been trying to find me jobs down here.
Uh-huh.
No, he can't lose you.
No, it's you
would never lose me.
Well, your husband is your husband is quite a fellow, so we're going to call that a rumor, Judy. Okay.
You think that's a rumor that I started, right?
Exactly.
So, back about a month ago, I was kind of upset about the donut hole thing.
Right.
And we figured that one out. So I've noticed then after the first of the year that some of my co-pays for my medicines change. Does that happen every year too?
Yes. So basically what happens is, the donut hole starts over every January 1st, but yes, the insurance companies are entitled to make changes to the cost of the tiers. Did you notice this while you were filling at the same pharmacy that you had filled at before, or was it when you went down to Florida and now you're filling somewhere else?
No, the same pharmacy, and they were cheaper.
Okay.
I mean, I'm not
Good.
complaining, but I was just wondering.
Yes. So yes, the plans can change slightly, but I saw that there was no reason for you to move off of your current prescription drug plan.
I just said, go, Erin,
I think, I
was really
asked
nice.
I asked the insurance company specifically just to lower Judy's drug costs because she was so mad about that donut hole.
I love
I love about Judy. I'm sure
Mm-hmm.
that she's going to bring us back some of those really big Florida oranges. She's like that.
Just see you till March, so I don't know if they will last.
All right. Well, let your husband eat them. It's okay.
Yes. Vitamin C, good for.
Otherwise, I would.
I
We've
understand.
been eating a lot of those.
Well, you're generous in that way, so thank you very much. We do appreciate that.
Yeah.
Well, good. So, again, Judy, thanks so much for your question. We appreciate it, and enjoy Florida, and we'll talk to you soon.
Yeah, so that is true that even if you don't make a change to your prescription drug plan from year to year, it can change a couple of ways. The premium can change, but also the copays on the tiers for the prescriptions that you are currently taking can change. In Judy's particular case, it sounds like those copays decreased, which is nice. Sometimes they move the prescriptions themselves to different tiers. They reserve the right to do that twice a year. So especially during the open enrollment process when you're picking a new plan. So you do want to watch that.
And one nice thing is that we know that in doing our coaching sessions with Judy as well as other clients, since you're able to estimate the cost of their prescriptions based on where they are in the formularies, this really helps us in terms of doing their financial planning, cash flow planning for healthcare expenses during the year.
Yeah, and for most people, we don't necessarily have to worry too much about it in terms of copays for prescriptions, because if you think about it, you pay for your copays right now out of cash flow, right? You don't have a separate bank account for your medical expenses in most cases. Maybe you have an HSA. You're one of the lucky few. I think only about 20% of the U.S. is actually using an HSA right now. So everyone else, you don't have separate money set aside to pay for medical expenses. Right. You're just paying it out of cash flow. However, for some individuals, when they get to Medicare, they are on prescriptions that are not treated the same as when they were on their group health insurance or even individual health insurance. So it does become to the point where it could become a financial burden if we don't factor it in. We want to make sure that, if you're having to pay $1,000 a month for an injection, which is entirely possible under Medicare, we want to factor that into your cash flow because you absolutely weren't doing that before you retired.
At the same time, it might put you in a position where you may want to have a discussion with your physician about options that are available to you. Right?
That is very true. Oh, have a have a health insurance text.
Very good.
Can HSA funds be used for long-term care, such as assisted living or skilled care? Yes, they absolutely can. I have not seen anyone make it that long with a full HSA like that, but if you have HSA dollars left over and you have been admitted to skilled nursing or assisted living, you can use those. They're considered qualified medical expenses.
Plus, there are other things that you can use them as well, which is reimbursing yourself for your Part B premiums.
That's right. Or you could reimburse yourself for long-term care premiums if you happen to be paying for long-term care.
As well as other out-of-pocket expenses for copays, et cetera, that you might normally see that aren't covered by your insurance plan.
Dental, any vision, you can use those as well.
Which is great. And, the great part about the health savings account is if you don't use it, you never lose it.
That's right. And if you don't use it, you will pass it on to your beneficiaries. So it definitely goes somewhere.
Which is awesome.
Oh, we have one more question.
Fabulous. Is this like the Erin personal text line here? Because they're not asking me diddly.
Well, fine. Why don't you know what? Why don't you take this one?
Okay.
What is your fee structure? That was the question, I swear.
We charge, Erin and I charge 0.25% per quarter, total of 1% per year, for the assets that we're actively managing that are with our broker-dealer. Pretty simple.
They're not all for me.
That was an easy one, right?
It was an easy one.
Exactly. So, and we do talk about that also in more in detail at our coaching sessions, but all of our clients pay the same percentage fee.
And not only that,
Because they all get the same brain power.
Right. But because we charge a fee, we're required to not only reveal it to you, but you sign off on it in multiple places. It's both on our account applications, shows the 1% fee, and then you also, if you decide to become a client, sign what's called an investment advisory agreement, which also reflects that there is a 1% fee for our services that's debited 0.25% per quarter. So there's many of opportunities to show it. Also, the cost is literally reflected on your statements. You get to see the tallies on the front page. Ooh,
very good.
I have another text question.
Wonderful.
My wife is a teacher and is about 5 years away from eligibility to retire. She inherited some family farmland several years ago. It provides about $5,000 of income annually after taxes and insurance.
That's great.
We are considering the sale of the land to buy out approximately 3 years of service time.
Gotcha.
Other than paying the potential taxes on the sale of the land, are there any precautions against doing this?
Well, no. I mean, I think you're looking at an opportunity cost situation, right? Which is how much is it going to cost you to buy those years as compared to the increased income that you'll receive by purchasing more years versus the income that you're receiving from the farm.
Versus apparently wanting to leave 5 years earlier, potentially. Maybe not wanting to work those 5 years anymore.
Right.
Weighing that.
Yes. So a lot of good questions here. And I think probably the biggest issue that they will have, at least they're addressing here, is the cost basis on the farmland.
Right, because you won't be paying taxes on the entire sale. It's just on the growth from whatever the original owners purchased it at.
Yes, and if you purchased it, you know what your cost basis is. If you received it as an inheritance,
inherited some farmland,
then what happened is it would be the fair market value of the farmland based on the date of the death of the person that you inherited from.
Right, so you'll have to go back and do a little bit of research there.
Yeah, I mean, what
because you said several years ago.
Sure.
So how does a person do that? Both, I guess this is farmland, but what if it was a residential home that they just decided to keep for several years, but they never had it appraised at the date of death? How do they determine that to meet the IRS qualifications?
I would assume, honey, that they would probably be engaging a realtor to sell that property now.
Right.
And we would say, as a part of your service, please do a little research.
Tell us what the value was on this day.
Well,
or the approximate value was.
Of comparable homes.
Comparable farmland, whatever it happens to be.
Exactly. I'm sure that they can do a little bit of research.
So as long as you can provide documentation where you got the number from the IRS, then usually that's okay.
Yeah. I mean, I'm sure you can go into like the sales of the county and the county records, et cetera.
Right.
I mean, there was Zillow 5 years ago. I mean, they should be able to do some research somewhere, but that's what you would do. And again, I think the Internal Revenue Service is interested in if you again, this is only if you get audited. Okay, is your best, give
your
us
best effort.
Right, show us your best effort, and if you made a good effort, then it is what it is.
Right.
Right.
Just curious, since it had been a couple years, it sounds like.
Yeah, I mean, it's not like a security, which is really an issue. Securities can be really, could be a big
securities
issue.
It could be more expensive for you to figure out what the cost basis was, because especially if dividends are being reinvested and things like that, they're all different cost bases at that point. So sometimes, but what happens is if you don't have a cost basis, then you have to claim 100% all the way to zero. So that's a decision you would have to make. There are ways around that, though, meaning that could become charitable contributions for you and such.
Well, that, or you're forced to hold that security until your death so that
your new beneficiaries get the step up in basis there.
Amen. Exactly. And these are all fun things that we love to talk about during our coaching sessions, right?
That's right.
Which are fun. They're also free. We offer them at our offices in Clayton. You can do it in person.
You could do it by Zoom, by phone.
Exactly. Whatever's convenient for you. Easy to do. Either go to the contact section with us at our website, jblfinancial.com, or you can send Aaron an email, aaron@jblfinancial.com, or jeff@jblfinancial.com, or give our office a call, 314-863-0008, 314-863-0008.
opinions voiced in this show are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial advisor or tax advisor prior to investing. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Private Advisor Group, a registered investment advisor. Private Advisor Group and JBL Financial Services, Inc. are separate entities from LPL Financial.
This is Jeff Lapidus, the Retirement Coach. We'll be back next week at 10 a.m. here on the Big 550 KTRS.